Welcome back. CCL Products reported a good set of Q2 numbers. Revenue growth came in strong. EBITDA margin growth was better than what the street was anticipating. The top line for the company is at 20%. Challa Srishant, the managing director at CCL Products, is with us on the show. Afternoon, and thank you for joining in. This is Rima here. First, if you could give us that, break up that top line number of 20% into volume and value. And what can you guide for the full year? Can you do better than 20% that you had guided last time?
So actually a large portion of the volume numbers, I mean, the guidance that we're given is closer to 20%. In fact, in Q2, there was a slight reduction in volumes in light of the breakdown that was there in Vietnam. Otherwise, things would have been a little better. Overall year guidance, what we had given is around 18 to 20%. So we are hopefully going to be in the same range going forward as well. Yeah.
Okay. So in that case, so what was the impact of the breakdown that we saw in Vietnam? Is it back to normal functioning capacity?
Yes, it's back to normal functioning in Q3. In the first, in last month itself, we came back online. We made that announcement in the market as well. Yeah, now it's back to normal operations.
Okay. So when we talk about volumes being impacted in Q2 because of this, what percentage would that be? If you can tell us what was the volume growth in Q2?
So volume-wise, on an overall basis, we were looking at, we were targeting around a 20% volume growth. But we were able to achieve maybe closer to 10 to 12%.
Okay, all right.
Okay. So what's the utilization level now at the Vietnam facility?
For the whole year, if you take it, we're looking at about a 50% utilization of the enhanced capacity that will be there for this year.
Okay. So in that case, let's talk about EBITDA per kg as well. In Q1, it was around 100 rupees per kg. How did it pan out in Q2? And with better volumes coming in Q3, what are the levels you're looking at?
So the EBITDA per kg more or less is the same. There's no change as such. On a percentage basis, again, there appears to be a difference because of the green coffee volatility that we've been seeing in the last year and a half.
Okay, and you are on track in terms of your EBITDA per kg guidance as well for
Yes.
FY24?
Yes.
You had acquired some brands in the UK, Lofberg's Group. What was the kind of revenue that you saw from this particular acquisition, and how can you scale that up going ahead?
So right now, last quarter, we were just doing the transitioning, which was taking place from the previous company to this. So there's not much that has actually come in because it just got completed towards the end of the quarter. And from this quarter onwards, we'll start seeing a little bit of more volumes coming in.
So, you know, in the previous interaction, you said that you can scale it up to 100 crores, but that's only 2 to 3 years down the line. Just for FY24, that's Q3 and Q4, what could the revenue contribution be from this group?
We are looking at maybe around 10 to 15 crores in the rest of the year. Yeah.
Okay. And you know, the other big focus that you have at the company is increasing the B2C sales, targeting around 200 crore rupees in FY24. What was it like in Q2? Are you seeing increased traction coming up as well? What are the value-added products that you're looking at in this particular segment?
So as far as a branded business is concerned, yeah, the target was closer to, I mean, higher than 200 crores. So we're on track for that. Products-wise, as of now, it's again a little bit more focus on the 3-in-1 products that we have. The existing products also, we are expanding our distribution reach as well. So the progress is good. And in fact, we're looking at a little bit more of aggressive growth from next year onwards. This year, in fact, the main reason why we're not focusing on too much on the volume growth in the domestic market is because we don't have sufficient capacity. And the new capacity will start coming in by April of next year. Then we can focus a little bit more aggressively.
So when you mean aggressively, would it mean higher marketing spends for the branded business and also higher revenues? If yes, by how much?
So we're looking at both revenue spends as well as higher sales. So we're going to be targeting closer to a 30-35% growth from next year onwards.
Oh, okay, 30 to 35%. And what is the current ad spends that you have, and how much would that scale up to? Because you'll have to go aggressive with that as well.
Yes, so we're not going too aggressive with the ad spends right now. This year, we're seeding the market. We're laying the foundation a bit more strongly. We are also cleaning up a lot of things with respect to the credit terms and all that. Now that the brand is becoming stronger, we're able to command better pricing as well. So all these things are in the positive notes. So next year onwards, we should be able to scale up more. So this year, we're spending close to maybe 14-15 crores for the brand. So next year, we're targeting maybe closer to 20-25 crores.
We leave the conversation here for now. Thank you very much for joining in. That's CCL Products for you, maintaining a 20% top-line growth guidance for the year. Get into a break. We'll come back with more action.